Hey, good morning, everybody. This is Angelo Christian. It is November 19th, 2016, coming to you today to talk about USDA loans, to explain to you how they work. And so I want to go over this with you in detail and educate everybody on USDA loans, the benefits, the requirements, what it takes to get a USDA loan, why it's so popular, why there's not a lot of companies that do them. So we actually specialize in USDA loans. We're one of the nation's largest providers of the government program. It is a government guaranteed loan, and it's one that we do very well and know a lot about. A lot of banks, most companies don't do them. We love them and we specialize in them, so it gives us a competitive advantage and an edge, compared to other companies. So basically, one second. Okay, so yeah, I mean USDA loans, I love them. Today we're going to talk about them and explain how they work and some of the benefits and requirements of them. So we're going to dive right into it. I got some slides and some different things we're going to talk about. So first off, the benefits of the USDA loan. It is a true 100% financing home loan program. So there's no grant, there's no down payment assistance. This is straight up 100% loan. So if somebody's buying a house for $100,000, they can get financing for $100,000. Okay, so they don't have to put a down payment like a conventional loan or an FHA loan where you have to put money down. They can get the straight 100% financing to buy a house. And so also the closing costs can be included. Okay. So, if the closing costs are $5,000 with the USDA, they can be either rolled into the loan, or they could be paid by the seller. So let's say the example that the closing costs are $5,000, and when you go to make the offer on the house, let's say that the seller doesn't want to pay the closing costs. He says, no, I want $100,000 for my house, and that's my bottom dollar. Well, you can offer him, 105,000 offer with 5,000 for closing. Okay. So that way you can roll your closing costs into the loan. Now, outside of and for that closing cost, that includes lender fees, title fees, to set up your escrow for your property taxes and your insurance. One of the cool things with the USDA that's really neat is right here, the equity in your home can be used to reimburse you for your out-of-pocket expenses. Not only do you have these closing costs, you do have some pre-closing expenses too that you're going to incur. So typically with a USDA loan, you're going to pay, you have about $500 for an appraisal. Okay. $300 for an inspection. Inspection is not required, but it's definitely recommended. That's to inspect the property, the integrity of the home, the roof, the plumbing, the electrical, all those things. The appraisal that appraises the property to determine the value of the home. So obviously, you want to make sure that you're getting your best value for a home. And you want an appraisal must be done. It's required. It has to be by an FHA licensed appraiser that we order through our appraisal management company. It's a local appraiser. The seller cannot choose the appraiser. The realtor cannot choose the appraiser. We cannot choose the appraisal company or the appraiser. It's all done through an appraisal management company, and they'll select what appraiser can be done. So the other thing is that when you buy a house, you generally have to put up earnest money, and earnest money can typically be 0.5% to 1% of the price of the house. So in this case, it could be $500 to $1,000 in earnest money. So, and that earnest money gets applied towards your closing. Okay. So if the earnest money is not used or needed, then it'd be refunded back to you. Now, the way earnest money works is that when you put up that money in good faith and to show your sincerity to buy the home, if for whatever reason you can't get financing and it's before your option period to get the loan commitment, then you can get it refunded for your earnest money. But if for some reason that you do get, a loan commitment and you decide to back out, the seller will keep your earnest money. That's why it's put up. So he's taking the house off the market, and because of that, you need to put up some money. It's just the way it works. And so it's different in all areas. It's not a firm number. It's a negotiation. The USDA doesn't require it. And so the other thing is that if the house has a well and septic, it could require, if the appraiser goes out there and he sees there's an issue with the septic, he could say that we need to get inspected. That you may need to get a sanitation inspection that could run a couple $100. And if the house has a well, you will need to get a well inspection. So there's certain things that are required, and so it just depends on the property and what you're looking at. But the bottom line here is that let's say that this house appraises for 110. Okay, so now you have 5,000. Appraises for 110. You have 5,000 in positive equity because your price was 105. So because you have that positive equity, the USDA will allow for you to get refunded for your pre-closing expenses like your appraisal, your inspection, and obviously your earnest money. So you can literally get the home with nothing out of pocket if you have that positive equity. So that's a really cool thing. And obviously you'd have to increase the loan amount equally by that amount. So in this case, if you bought the house for 105 and you want your earnest money back, that's going to come back to you. But if you want the money back for your appraisal and your inspection, your new loan would be for 105 plus 800 for your appraisal and your inspection. Now, so your loan would be for 105 800. Okay, so now that's your base loan amount. All right. So with these government programs, they do charge a fee. There is an upfront fee, and that's to issue the loan. That's to keep the USDA in business, and that rolls into the loan. So the USDA charges 1% to give you the loan. So in this case, if they rolled in the money for the appraisal and the inspection, they'd be at 105 800 as their base loan amount plus 1%. So their gross loan amount or total amount that they'd be financing would be 106 858. So total loan amount would be 106 858. Because the USDA charges 1%, like FHA charges 1.75, the USDA charges 1% to give the loan. Okay. Now, in addition to that, there's also a monthly mortgage insurance that you pay with the USDA for the life of the loan, and it's 0.35%. So in this case, at 106 858, you multiply that by 0.35%. And then divide that by 12 equals 31.17 per month that they would pay, and including their property taxes and insurance. Whenever you do a government loan, you have to escrow your property taxes, your homeowner's insurance, and your mortgage insurance. And if there's a homeowners association, you do have to have that escrow too. So just to let you know. So that's how that works with the USDA and the monthly mortgage insurance. There are no 15-year or 20-year fixed loans for USDA. It's only a 30-year fixed mortgage only. There's no prepayment penalty on the loan. You can pay off the loan. There's no balloon. You can refinance into conventional or FHA or refinance into USDA. If you refinance into USDA, you cannot take cash out. It can only be to lower the interest rate. If you refinance in the FHA, then you can take cash out, or if you refinance in the conventional, you can take cash out. that's fine. So, okay. You can buy a brand new home. You can buy an existing home. You can buy a foreclosure. You can take our pre-approval to a builder, and if they'll build a house for you, then they can build a house on their line of credit. Um, and then we can give the funding once the house is done. You can buy a brand new mobile home with a minimum $300,000 loan amount with land. If you do a foreclosure property, the utilities do have to be turned on for the appraiser. If the utilities cannot be turned on, you cannot do a USDA loan. That's one thing to keep in mind. Escrow repairs are allowed. That's where you can get funding up to $5,000 for fixing required items with the home, like flooring or cabinetry or broken windows, or if there's something wrong with the heating system. But it cannot be used for major structural or foundation issues. Okay, so but that is definitely something that can be done with the USDA loan. And actually, with the FHA training seminar that I did previously, you can learn more about escrow repair. We actually have a whole video on escrow repair, so definitely check that out. So let's move along, and we can talk more about some of the great, benefits and requirements with USDA. So take a look. So let's go and look. Let's take a look a little bit back up for a second and see what is a USDA loan. Okay. So a USDA home loan program it's a federal home loan that's actually guaranteed by the Department of USDA. It's a mortgage loan. Okay. Basically the purpose behind it, and you can read a lot about this on Wikipedia, and there's different websites. And so the purpose behind it is to spur the economic growth and development of rural areas, smaller towns, and cities. And so they want those smaller economies to grow, like on the outskirts of major cities, and so or just rural areas. And so to bring investment from business and industry, they allow people the opportunity, whether you're a first-time home buyer or not. You do not have to be a first-time buyer. But they allow people the opportunity to literally buy a home with no money down, 100% financing. Okay. There are requirements to the program. We're going to talk about the requirements. This is not a farm loan for farmers. There is a farm loan for the USDA. This one is for single-family residential. This is not the farming program. Okay. And this is for single-family. And so there's two different types of USDA loans. There's a direct loan. And this one is directly to the federal government. We do not do that loan. We use a guarantee loan that's done by a bank, and that explains that here. Okay, so that's what we specialize in, is the USDA guaranteed program. And so you can read all about the USDA loan, and if you're in the history and all that about how it got started and set up. But that was the basis of why this whole thing has kind of evolved. And so the USDA sets aside money every single year for the program, usually between $2 to $5 billion is what they set aside. And once those funds are out, they're out for the year, and you have to wait for Congress to set aside some more money. The last time the USDA ran out of money was in 2012. And so, and if that happens, you either have to flip your customer to FHA or wait for the government to put money back in the account to do more USDA loans. And so every year they've increased the budget. It's available nationwide, and so it doesn't matter whether it's Hawaii, New York, but it is for rural areas. There's a map that we're going to take a look at, and you can check out where the property eligibility requirements are. So we'll take a look at that now. This is the website where you go to check out the USDA property and income eligibility. So it's really cool. You can take a look at it, and I'll show it to you. So let's take a look at property eligibility. First, you come to this website, eligibility.sc.egov.usda.gov. You can just type in Google USDA eligibility, and this will come up as one of the links. So I just put a USDA eligibility map. I check this one right here. It normally comes up first. Okay. And then you hit accept. Okay, and we're going to type in, our address here at the office. Type in an address here. Okay, so here's what pops up. It says this address is not located in an eligible area. See that? All this brown. So, and then we can zoom out. I think it's going crazy, huh? All right. All right. So, you're looking at this, you're wondering, what does this mean? And, we're going to explain it. So, all the brown area is not eligible for USDA. That's for the 3.5% down urban program that we do, the FHA. So you can buy a house anywhere in this area, in the brown area, but it's 3.5% down. So all of this area, the brown area, that's for the metropolitan urban program with 3.5% down. For the zero down, it has to be in the white areas. Okay. So all of the white area is eligible for zero down. So you can go in any of these areas and it's zero down for 100% financing for USDA. All right. And you can type in any address in there, it should pull up. Sometimes a new construction, it may not pull up yet and you have to look closely or check. So, I mean, and when you zoom in, let me see here. You might find some areas that are like little pockets, like around here, right by the office by Huffman, that's eligible for USDA. You can move the map around. And you might find little pockets in there or you think that they're not really rural. A lot of these areas, we don't live in a rural area. But right here by the office, it's eligible for USDA right down the street, 2 miles down the road. And then you can get 100% financing. So that's a really cool thing. So now there is income requirements for this program. This is not available for, the rich millionaire or people that are making, high income. So we're going to take a look at the income requirements here and the deductions for the program. So basically it's the tab right over it says income eligibility. So you click on that and it says single family housing income eligibility. So let's just pick your state. Let's pick Texas. And let's just pick Harris County. Scroll down, look at all the different counties. Now, with USDA, the amount of people that are living in the home influences the maximum income limit. Okay, so if you have 4 people living in the home, 0 to 4 people has the same income bracket, income requirement, and 5 people and up has a different income requirement. And so it says include all persons living in the household except foster adults and foster children. We cannot include foster adults or foster children. And they want to know number of residents that are under 18 years old, disabled, or full-time students. When you have people that are full-time students or disabled or they're under 18, that can help to give you more deductions so you can qualify or use more income to qualify. So, and if you're over 62 years old and you have medical expenses, there are some more deductions. Or if you're disabled and you have disability expenses. So we're gonna actually talk about that. So let's just first start with 4 people, and you can look at the differences here because this is a really important area or piece to this. So if you hit next, and I'm going to type in here just generic. Let's just say this is for monthly income. I'm going to type in 5,000. Okay, and then you're going to hit finish. And so here's where this thing comes out and it tells you here for the metropolitan area, Houston, the Woodlands area, what the applicant's eligible for and ineligible. We're focused on the Section 502, the guaranteed loan, like we talked about. Not this one. We don't care about that one. We're looking at this one right here, the 502 guaranteed. This is the income that I put in. You didn't put in any deductions. And this is the income limit for a family of up to 4 in Harris County, $79,700. Okay, so that's the income limit for a family of 4. Now, if we go back and say that we put, we have a full-time student and one full-time student. Let's see what happens. Okay, so we get a $480 deduction to the income. So instead of making $60,000, it reduces our income cap requirement to $59,520 to help you get underneath that cap, right? So these type of things, you got to ask these questions when you're qualifying the customer, the prospect, see if they have these deductions. Let's say that you have someone that's over 62 and they're disabled. Okay, let's see what happens. That is asking for more questions. If there's childcare expenses, there are medical expenses, disability expenses. These are different things that can come up. So we're going to talk about the medical expenses and disability expenses. So let's say that we don't have any childcare expenses. We're going to talk about deductions for USDA, and we don't have any medical expenses. So I'm not going to put anything in there right now because it's a separate subject I want to talk to you about. But let's just go ahead and finish this and see what happens. Okay, so now we get another couple $100 on our deductions for having a senior. Okay, so you got to ask these questions because it can really help if you're going to be over the cap for the loan program. You want to find this information out. Okay, so it's real important that you really take the time to learn because it can make the difference if you could get the deal done or not. So, and now go back and I want to do this now. I want to change this and I want to put that we have, let's say we have 5 people living in the home. Okay. So now we got 5 people living in the home. And I'm going to use the same income. It's 5,000. It's just for a scenario. And now look what happens. The income cap now for the program is now 105,200. So it went from 79,000 to 105,200 because you have more people that are living in the house. Now with the USDA loan, this income cap, what it's referring to is total household income. It doesn't matter if the people are not going on the loan. So even if your wife's not going on the loan with you, they need to know her income. Even if your kid that's 18 that's working at McDonald's is not going on the loan with you, it's total household income. And so they're going to want to know, there's a form they fill out. They want to know everyone's income that's going to be living in the house. And this is at the time of closing. What happens after closing is irrelevant. This is at the time of closing. What is the income, the snapshot in time? We do this closing, what's the income? If you win the lottery afterwards, that's fine. You get 10 jobs, that's fine. But it's as of right now. So it's very important that you understand that because anything in the future can change, but this is as of now. So now there are some deductions that are allowed with USDA, like I was mentioning to you earlier. Um, so there are deductions for you have first medical expense deductions, right? So you have medical for senior citizens only. Disability for senior citizens, 62 or over. Daycare deductions. Unreimbursed expenses is a deduction. Business losses, capital gain losses are not deductions to the income cap. They are deductions to qualification of income. Okay, so business losses, capital gains, any other type of losses that you may incur are not deductions to the income cap. They are the reductions to the income for qualification. So we're going to take a look at these different, talk about these different deductions for a second. So if somebody has daycare deductions, they have to be legitimate and they have to be proven, and there has to be either a letter from the daycare or show on the tax return to deduct that off of the gross income. So let's say that they have $10,000 a year in daycare deductions. They send the kids to daycare, and so yeah, I mean, it happens and it's expensive, but it's real. And so let's say that they have 5 kids and they have, our 5 family of 5, and they have 3 kids under the age of 18. And that they have, 10,000 in annual daycare expenses, and the couple is making, 10,000 a month. Okay. So you get that letter from the daycare showing that they have that, and yeah, you can use it as a deduction. So their gross income was 120 minus the deductions for the daycare. Now their qualifying income is 108,560, but notice the cap is 105,200. So they're exceeding the cap by 3,360. Okay, so they're still over the income cap. But those are different deductions that you can use. So that daycare is one. Now the other one is unreimbursed expenses. Let's say that these are what are unreimbursed expenses? Generally, the following expenses are deducted that are things that you pay for to that you're not being reimbursed for at your job. Okay. And this could be, if you're in a certain trade or business or something with your W-2 job, could be, here's a list of them right here. And basically what you're saying is that you incurred these expenses and you didn't get reimbursed for them. So it's a deduction to your income. And this is on line 2106 of your tax return. You need to look at that because it's a deduction to your gross income. And if you have that, that can be a reduction. So, if let's say that the person had, 5,000, of unreimbursed, that would reduce their income here, by the 5,000 a year. So instead of the 100,000 in income, now they would have 95,000 in income. So that would come out to so 10,000 a month. So you'd reduce off 416. So 10,000 minus 416 comes out to 95.84 because of the unreimbursed. So let's see if they qualify now. And that's why you have to ask these questions, because if you don't ask these questions, it could cost you a deal because you're not digging. So now the total household income is 103,568, and now they're below the income cap. So they're good. Okay. Now, a couple caveats to this with the USDA with the income. They're gonna, with the USDA, how they're gonna look at the income is for, we're talking about two different things here: income cap, and there's income for qualification. So, and you got to remember there's all different types of scenarios with income. But if you have discretionary income like commissions, bonuses, overtime, and you have a situation where in 2014 the guy had 80,000 in commissions, and then 2015 he had 50,000 in commissions. They're not going to average the 2 years together for qualifying for the loan for the debt ratio. They're only going to give him the year-to-date or the 2015 commissions because his income is declining. So when you see income is declining from one year to the next, they're only going to use the current year to qualify. And so, so that's a very important thing. But for purposes of the cap, let's say that the guy, for now we're in 2016, and in 2015 he made 80,000 in commission, but in 2016, he's on track to make 120,000 in commission. Well, they're not going to average the two commissions out. They're going to look at his year to date and see that he's on track to make more income for 2016, and he's over the income cap because he's making 120,000. So if the income is inclining, for purposes of the cap, they're going to go off of the year to date. For purposes of qualification, they're going to average it out though. So let me make sure you guys understand this. So if the guy in 2015 made 80K commission, and it doesn't matter if it's commission, bonuses, any discretionary income, and now 120K in 2016 through 11/19. So for debt ratio, income on the 1003, you average out the 24 months by adding the two together over 12 months plus 10 and a half through November 19. So that's 22.5 months. 200,000 divided by 22.5 is 8,800 a month. Okay, so that's for what you put on the 1003. okay, for qualifying for debt ratio. You average it out. So, and how we did that, we did 2015 is 12 months, and then we do through November 19th is 10 and a half months, because November hasn't been completed yet. So you have, 10 months through October, and then half a month for November. That's 10 and a half. And so you take the gross earnings for both years and divide by that to get the monthly income on the 1003. Now for the cap requirement is 120K divided by 10 and a half. And that's 11,428. So there's two different things going on here, and you need to see that. Because for the cap requirement, he's over the cap. See? Because you just take the year-to-date earnings, and he's over the cap. So you just need to look out for this, because it's very, very important when you're calculating income for qualification. And like I was saying earlier, for let's see, for declining income, declining income, 80K commission, 2016, 30K commission. This guy, you can't average this out. You can only give him credit for 30K. So it's 30K, over 10.5, which is $2,800 a month. You can't average out the income for qualification. Now for the cap requirement, you would average it out. So. Fine, still within means. See, a couple of things, like if you're on a salary, then you get immediate credit for your salary. If you're on hourly, you have to have a 2-year history of any overtime, any PTO, need a 2-year history. Pretty much everything needs a 2-year history. Commissions, bonuses, and those would all average out. If you're at another job, same industry, you can use it. If you're in a different industry and you've got commissions, you cannot use any bonuses or commissions from a different industry. It has to be in the same industry, similar line of work in order to use that income. So if he was a mechanic at Ted's Automotive and then went to Hilltop Chevrolet and became a mechanic, and he's been getting a lot of overtime for 5 years, you can use it all. But if he was a deckhand on a ship and you got overtime and then became a mechanic, you can't use the overtime if he hasn't had the new job for 2 years. So you have to make sure you understand how that works with USDA. And so, and the difference between the income cap and the income for the qualification with the debt ratio. There's two different things going on there, and how the limits work. And so, going back to the deductions, there are deductions for other things like medical and disability. And so basically, the way that that works, let me just go back. Let's say they are 62 or over and they're disabled. Let's just say that. All right. And it says enter the amount for medical expenses when combined with disability. And it has to exceed 3% of their gross annual income. So what that's saying is that if we take the example here that they make, 95.84, so their medical expenses or disability expenses has to exceed 9584 multiplied by 3%, has to exceed your annual income, which is 115,000 times 3%, has to exceed 3450. Now there's a certain amount of deductions that are required, and so there's a list, and it's here in medical expenses. You click on the question mark, all the different things that are allowed, and disability expenses that are allowed here. And you can check that out here on the website. There's many different things, but the way it works is the math is in our example here. If we have 9584, let's just take a look and see. So medical and disability has to be over 62 years old and has to be the list of those approved expenses. In our example here, 9584 is $115,008. Income multiplied by 3% is 3450. So if their expenses are below that, then you can't use it. If it's above that, then you can. So let's say they have 10,000 expenses. So you do 10,000 minus the 3450 deduction, and that's what you can use, which is 6550 as the deduction. Okay. And then you just hit finish. And I'll tell you that their annual household income was 115,008. They had deductions of 16,950. Their household adjusted income was 98,058, and so they're below the cap. Let me put annual in there. Just making sure on that. So yeah, that's really cool. So got that. Okay. The process, with the USDA loan, basically, the way that it works here, and what I have up here is the Texas USDA website. So the thing that's different with the USDA, it does take longer to close. It takes a couple weeks longer generally to close than FHA or conventional because there's a secondary process that occurs with the USDA loan. So it goes through the bank and we do the underwriting, and the appraisal and the whole thing like a regular loan. But before the loan can go to closing, it actually has to go to the local USDA office in that state. Okay. And basically what they do is kind of like a second underwrite of the loan, where they review the loan again by the local USDA office. And it's kind of like a second underwrite just to make sure everything's done. And so it does take longer for that review, and it's subject to their review and turn times. We don't have any control per se on how long it takes. It usually takes about a week. It could take 2 weeks. Sometimes it takes several months, just depending on how busy they are. But every state has a local office, and you can check there to find out what their turn times are by calling them or getting with your processor to find out what their review times are. And they have the power to make the final decision on the loan. Generally, they go with what our underwriter says, but not all the time. So it's important to understand that. And so basically, you can check out just by going to, type it into Google, the USDA local office in the area. And I just did that in Killeen, and it's in Temple. And every city or every state has a major location for the USDA local office, and you can check that out there. And like I said, call the local number, and it'll tell you how long it's taking right now for them to issue the guarantee on a USDA loan, and what how is the government involved with the bank on these loans? Well, basically they're insurance. They're basically the insurance company. They pay off the lender if the house goes into foreclosure. The USDA does usually about 90% of the money that was lent. So if you lent $100,000 and the people go into foreclosure, the USDA is going to pay us $90,000 to reimburse us. That's what the USDA does. That's why they charge the premiums that they charge. So it's big business for them. So, and that's how it works. So if that makes any sense. Let's see here. So let's talk about the property requirements real quick, because this is also another important piece. We talked about location eligibility. It is for single family homes. Multi-units are not allowed. No duplexes, no multi-unit condominiums. It can be a freestanding condo. So freestanding condo, it's okay. You get the point? Freestanding condos are fine, guys. No problem. Okay. Modular homes, no problem. Down to a $50,000 loan amount for modular. All right. Single family, no problem. High-rise condo, can't do it. Okay, can't do high-rise condo with USDA. So that's not what the program's intent is. And like I said, it's not a farm loan. It's a single family loan program. Modular is considered single family. Mobile home. Mobile home, no bueno. Okay. If it's brand new, it's possible. If it's brand new, never been titled before, with a minimum of $300,000 loan amount coming straight from the dealer onto the land, and it has to be on an approved FHA foundation. and it has to be a double wide. No single wides allowed. And we really don't want to mess with them, but just to let you know. Let me see. What else with the USDA and the property? I have an appraisal here I want to show you, and it's unfortunate this deal didn't go through, but the loan officer didn't do his due diligence, and wasted a bunch of time by not making sure the deal was solid. And so, it has the appearance that like a regular house. Okay. And it looks good from the front, but as you look deeper into it, you start to see that there's some issues with and this is an appraisal report. We have trainings on appraisals, but I just want to show you that if you're encountered with a situation like this where I'm not saying there's anything wrong with the house, like I don't like it. I'm just saying for the program, it doesn't fit the program. You got this one barn here that looks kind of rinky-dinky, and then you got some other sheds over here, and they don't like to see a bunch of outbuildings. But look at this. You got hay barns in there, and it's income producing, from the hay. And it's no income producing properties are allowed. And so the USDA, denied the property, and we had to go find another home. So if you encounter a situation like that, you need to check with your underwriter, or to file and see if the property is going to be eligible, or check with the local USDA office. You can email them and have them take a look at the property and see what they think. They may do it, they may not. This one was a little bit too far on the borderline, and they wouldn't do it. So don't just deny the deal. Check with the local office or check with your underwriter and see what they say. They may be okay with it in some cases, they may not. So, but don't make the decision on your own, especially if you're new and you don't know. You don't know what you don't know, but you have to check and see with that local office. So that's a real important thing. So the other thing is on credit requirements. I do want to talk about that because that's very important. Like we said earlier, 620 or higher credit score. We have the matrix here. I want to pull up the matrix real quick. So USDA, yes, 620 to 640 with USDA is an automatic manual underwrite on the loan, and the maximum front end debt ratio you can have is 29. The maximum on the back end is 41. Now you cannot use GUS approval. GUS is the automated underwriting system for USDA, kind of like desktop underwriter for FHA loans, so they use GUS for USDA. If the loan is, if the credit score is 640 or higher, then you can potentially go a little bit higher. With the debt ratios, it's up to GUS approval. That's really the absolute max with USDA is 34.99 on the front and 45.99 on the back end. It is for primary residents only. No, non-occupant co-signers are not allowed. FHA, you can have non-occupant co-signers for FHA, but not for USDA. So you can't do it for second homes or investment properties. And so we do know how to calculate the debt ratios for USDA and FHA. So a couple things with the USDA. Let's see here. The mortgage insurance, like we talked about, the 1% up front, the 0.35% monthly. Typically with USDA, the max concessions are 6%. That's what's maximum allowed. Follow your chart to see what's needed. It doesn't mean you're going to always need 6%, but that's the maximum. Um, for student loans, use the 1% multiplier times the balance, unless they're in a fixed payment plan. So you just take whatever the balance of the student loans. If they're in deferment, then you would take, let's say that $50,000 in student loans, it'd be times 1%, would be $500 a month for student loans. Or you can have them enter into a fixed payment plan. Income-based repayment or graduated payment is not allowed. Collections follows FHA. If it's over 2,000, you hit them with a 5% multiplier. Or they can be into a fixed payment plan for 3 months, or they can pay them down below 2,000 to omit them. I will tell you, if you have a manual underwrite USDA, if it's a manual underwrite USDA, then you really can't have any open collections on the credit report. It's pretty much going to probably be a no-go for serious collections or charge-offs. Charge-offs are different than collections, guys. Remember, with charge-offs, they've been charged off by that bank, and that's not included in the 5% multiplier. So let's say you had a charge-off from Discover, and it shows on the credit report as a charge-off, then that's not included in the 5% multiplier, but it still looks really bad for the USDA loan if they have that. And so they may not like the loan if it's a manual underwriting that has that on there and have to get a Gus approval in order to probably be okay. But if not collections, if that Discover account was sold to Midland Funding, which is a collection agency, now they're coming after you, and it shows on a collection for 5,000, then you hit them with the 5% multiplier. So basically, we know how that works, from our earlier trainings, that if they have a $5,000 collection, you multiply that by 5%, and that equals 250. And that would have to be added into the debt ratio. Okay. If somebody has they're in a 3-month payment plan, you can use the payment plan. Let's say they've been paying on this for 3 months, they're paying $80 a month. You can use that, but you can't prepay the 3 months. You have to wait the 3 months for them to make the payment. So that's how that works. So, now with USDA, and I'm gonna talk to you about the disputed accounts here in a second to explain how that works. With bankruptcies, 3 years from Chapter 7. So with USDA, it's only 2, or FHA, it's only 2 years. Without USDA, it is 3 years from a Chapter 7. Chapter 13 is 1 year from the filing date with the 12 payments on time. Remember, Chapter 13 is the repayment of a bankruptcy. You can literally be in the bankruptcy, it says, from the filing date, not the discharge date. So it's 1 year for a Chapter 13. Chapter 7 is 3 years from the discharge date. Foreclosure is 3 years from the trustee's deed. We've seen a recent change with the USDA. They're going off of what it shows on the credit report for the 3 years. So that can be a relief for some people if the trustees they happen afterwards. And for the short sale, it's 3 years. So the short sale is like a foreclosure. So let's see, with the USDA, it is owner occupied only, like I said. You must have 2 trade lines with the USDA that are at least 12 months old or greater. And it can be opened or closed accounts in order to have a GUS approval, automated underwrite. And basically, like we talked about with FHA, you're always wanting to get the computer, the automated underwriting decision, so you can have access to expanded debt ratios, lower interest rates, favorable underwriting. So basically, this is the GUS website. And what we do, we take the loan and we import it in here, and it'll tell us if it gets approved or not. Okay. So, and there's certain requirements in order to use an automated GUS underwrite. And like I said, you get access to expanded debt ratio requirements like we see on the matrix here. You have a GUS approval, then you can go to higher debt ratios, lower interest rates, easier underwriting, less restrictions. And there's a few things that downgrade it to a manual underwrite. If we look at a credit report, and we're going to look at one here shortly, but 2 trades, 12 months or greater history. Open or closed is required. If you don't have that, then it downgrades to a manual underwrite. Then it's a manual underwrite, and you have to follow manual underwrite. And that means you need to get alternate trades. You need 12-month rental history. Three plus months reserves will sincerely help. You're going to need a total of 4 trades, and these can be rental, counts as 2. Can use utility bill, cell phone, Netflix. Must be in borrower's name and show good standing for 12 months. So that company, Netflix or whoever, is going to have to provide a letter on their letterhead showing that Mr. Jones had this account for 12 months. He's been making the payment on time, and so sometimes you can add, let's say that it's in the wife's name, you can add Mr. Jones to the account to help to get him that alternate trade line, and then that would get added to the credit report as another line of credit. So that's what you would do for a manual underwrite. that's really important to make sure that you, when you're looking at the credit report, we're going to look at this credit report here that we have downloaded and kind of give you an idea about how to read this. So the bar looks like you got really good scores, and you're thinking, everything is solid, and which it can be, but you just gotta know what you're looking at. So this is a summary of the accounts: auto, revolving, the balances, the payments, everything. Then we're going to look into the accounts right here, and this shows, if it's a joint account, what bureaus are reporting to the type of debt, when the account was open, how long he's had the account for. Remember, you need 2 of them that are at least 12 months or greater to avoid a manual underwrite. It can be open or closed. The collection accounts, charge-offs accounts, student loans that haven't been paid on do not apply to that. It has to be open accounts or closed accounts for the last 12 months. Now, one of the things that what they've done here, you see these right here, like a water bill. This is an alternate trade line that's been added to the report. Utility company. These all trades, insurance that's been added to the credit report to help to give him credit, and it shows how long he's had it for. We've done this because it was a manual underwrite, because he had less than 12 on his reporting stuff. So one of the things that also that you'll see here, it's important to pay very close attention to. And here it shows BA, and originally how this loan was pre-approved was as a regular USDA loan with a GUS approval, because they thought, oh, he's got the 12 here, he's got the 12 here, he's got those 2 accounts, so he's good. But this A stands for authorized user, and with USDA, the requirement is for authorized user is they either have to be your spouse or they have to live in the home with you. And this borrower, it was his mom's account, and his mom was not going to be living in the home with him. And because of that, and if you kept that account in his name or on his credit report, then it would downgrade it to a manual underwrite, because the authorized user, him, is not living with it. The other person, the main credit borrower, is not living in the home with him. This is his house for and it's not a spouse. So we had to go back and get these alternate trades to because it was downgraded to a manual underwrite. So it's important that with USDA with the authorized user account, you got to make sure, if you see this A here, is it the spouse or is the person going to be living in the home with you? Because it does matter, and you need to find that out, because it'll make all the difference in the type of loan that you're going to structure, if it's going to work or not. So that's a really important piece to look at when you're doing USDA loans. Let's see here. With yes, disability income, fixed income that's non-taxable. If you have a fixed income that's not taxed, let's see, where is that? Yeah, FHA and USDA, you want to have at least 1 credit score. If someone has 1 credit score, it's a manual underwrite. So you really don't want to do a manual underwrite. You can just have them, try and see if they can either add, if they have a spouse or borrower, add an authorized user to prevent it from giving them another score, boosting up their credit, to prevent from a manual underwrite. Or opening a secure card or adding rental history. Whatever we can do to get out from a manual underwrite is always preferred. So on the, just looking for the, okay, the SSI is grossed up with USDA, 25%. That's a Social Security disability. So, you know, if somebody is making, you know, SSI income of $1,000 a month plus 25% equals now $1,250 that you can use for qualification. You know, so but it has to be non-taxed, and if some of it is taxed, you can only use the non-tax portion. You'll find out when you look at their tax return or their SSI statement what percentage is taxed and what's not taxed. But that can help to gross up their income. And if they have dependents that they're taking care of, then that can be used as well, but it has to be under their care. It can't just be someone that, you know, they added their name to a disability award letter and they're not really taking care of them, they're living in another home. They're not going to go for that. It has to be a true dependent. With child support, if you're using child support for qualifying, it has to be court ordered, and we have to see a 3-year continuance. So you need 3-year continuance and 12 months cancel checks showing proof of income. If you can't prove this, then we can't omit it. We can't use it. Okay. So that's a really important piece too. The other thing with USDA, if you're in a situation where USDA really cannot own any other real estate. So if the guy owns a bunch of rental properties, he can't do a USDA loan. Okay. There are some extenuating circumstances or exceptions to the rule, but you know, this is not for somebody that owns, you know, homes and they're trying to move into another primary home with USDA. They would require that that person, you know, sell their other houses before they can get a USDA loan. Now, a mobile home is not considered real estate, especially if it's in a rental, you know, a community or lot. And if it's a single wide, the only time that a mobile home is considered a real estate if it's on the land that they own, it's a double wide, and they've converted it from personal property to real property. But most of the time, that's not the case. Most of the time, 99% of the time, those mobile homes are they're kept as personal property. If it is real estate, real property on land, then that would be considered a real estate asset, and that would have to be sold or liquidated or removed from title in order to get a USDA loan. So that's a very important thing to understand. You know, now unless there are exceptions. You know, let's say you got a job transfer and so in this case, and you own a home, well then you can get a USDA loan, but you have to qualify with both mortgages. You just can't lease out the house. And even if the house has 25% equity, you still have to have that house leased out for at least a year before you can omit that debt. So that's a really important thing to understand with USDA. So I want to make sure that you guys got that part because it is very, very important. Let's say that somebody was gifted a home, and it's in their name. They would have to remove that home off of their real estate holdings if they want to get a USDA loan. You can't own any other properties unless it's, again, from a job transfer or current home is unlivable, deemed by FEMA, local county, and we have proof of that. If that's the case, then we could potentially omit, or they could retain that home and then go and get another house. So it just depends on what the situation. If they just say, "Oh, my house is dirty or nasty," well, that doesn't matter. You need something official from the local county or FEMA showing that it's unlivable. There is something with increase in family size. If you have a small home, like a 1-bedroom house, and now you have 5 kids, and it's hard to get that one approved, but it could be potentially approved. If you have just a massive increase of family, and now you need a bigger house where you could retain your current home, that's a tough one to get approved. You definitely want to check with the local USDA to make sure that would work before you ever give someone an approval letter. And that's the thing, is that you want to be resourceful and check with your local USDA office or your underwriter. I do both just to do checks and balances. Sometimes one's right, one's wrong, and I always like to do both just to check to make sure. So because it is very important that you find out on that. Let's see here. With with the accounts in dispute, this is interesting. It's a lot different than FHA with the accounts in dispute. So you see this right here for USDA. Oops. Okay. So with FHA, if you have accounts in dispute and it's medical, it doesn't matter. But for USDA, if it's medical and you have accounts in dispute, it matters. So to keep the GUS approval, the accounts in dispute have to be over 2 years old, and they have to be less than $500. If it's over 500 and less than 24 months, then it's downgraded to a manual underwrite. Right. So when you're looking at the credit report, you're looking for accounts that are 2 years old, right? So you look over here at the day of last activity, and it has to be at least 2 years old, and it has to be less than $500, the balance, if you want to keep that account in dispute and do a USDA GUS approval. So you may need to take those accounts out of dispute if you see them, if they're over 500 or they're less than 2 years old, or if you're trying to get it approved as a manual underwrite and you want to keep it in dispute to keep the score up, that's something that you may need to do too. It just depends on what you're trying to accomplish with it. But that is a little bit of a tricky nuance compared to FHA, where if you have an account dispute with FHA and it's medical, that's okay regardless of the amount. Whereas with USD, it's not okay if it's over 500. Now, so if the account's $300 and it's 3 years old and it's in dispute, it's fine. It doesn't matter if it's medical or not. The other thing with USDA is that if you have the payment plan, even for public record stuff, um, you know, if you're paying on a judgment, if you have a judgment that you have paid on for 3+ months or IRS debt, it does not have to be paid off, but the payment has to be included into the debt ratio. Okay, so that's an important thing to also keep in mind about with the USDA loan. Let's see here. On the one other thing I want to talk to you about that's real important that I think is the we've talked about the income, the credit, the requirements for that. So the other thing that we want to talk about now is the streamline refinance. So we'll talk about that. It's a USDA loan, but remember they have to currently have a USDA loan. So if they have an FHA loan, they cannot refinance into USDA. It has to be a current USDA loan, and they're going to refinance into USDA. So and the USDA loan, the Streamline Assist, basically, here's and these flyers have been sent out to you. Shows you what's required. The current payment has to be current on the payment for at least 12 months. Credit report, at least a 620 score. The payment has to be reduced by $50 or more. The new rate cannot exceed the current rate. No lates in the last 12 months. Manual underwrite. No new borrowers can be added to the loan. Must be 30-year, yes, 30-year fixed. No cash out. Closing costs can be included without the appraisal, so there's no appraisal required. You have to verify income for everyone living in the house to make sure they're within the income eligibility. But the benefit is, like, let's say that the guy, he did a USDA loan like we have one now. He got a 7% rate, 8 years ago, and he wants to do a streamline. You give us a call, and we can refinance him, and you don't have to pay for an appraisal, which will help to expedite the process. You can, take a week off the close date, and close your loan and save the money on the appraisal fee, get your closing costs included, and have no money out of pocket and drop your interest rate and your payment. So it's a really cool program to do if you currently have a USDA loan. So, but that's the Streamline Assist Refinance USDA. But those are the requirements for it, and it has been sent out to you. You do have that. So a really good program. If you get someone that calls in, they currently have a USDA loan, how they can realize some savings. So no appraisal fee, closing cost included. Those it uses the new upfront MI, not the previous. So we got some good savings right there with the USDA Streamline Refi. Really good program. Shut that out of there. Okay. So So we got that. I think that's pretty much the main areas that we wanted to cover with USDA that we talked about. There wasn't anything else. I think we hit the main pieces that we wanted to discuss. So, okay, guys, I'm going to upload this to the drive. Please check it out under USDA loans. Thank you so much for joining today, and I hope it was really educational and helps you with your production and understanding how to qualify customers for USDA. All right.